what we do is when we can measure those different pressures that cause it to rain, well, here's the two factors that are important. You have to be able to identify those factors, number one. And number two, the fact that it takes time for them to build is what allows them to be forecastable. And so once we can forecast the oncoming weather, well, in the market, it's the same thing. We can measure and value the oncoming poor market conditions, then we know that we're coming into a condition that's probably not going to favor our outcome. We know how to filter ourselves out and stay away from the market rather than going in at every opportunity we see.
Welcome back, everyone. Today I'm sitting down with Roger Khoury, and we'll talk about what he's doing, his journey in market forecasting. So how's it going, Roger?
All right, good to meet you, and it's a pleasure to be here. Thank you for having me.
Yeah, pleasure, of course. So you don't have the typical background of people that interview you on a podcast. You are focusing more on forecasting, but maybe take a few minutes, tell people who you are and some background about yourself.
Sure. So I started really trading and interested in the markets back in 1996 when the trading revolution took off. And so I had maybe a 14-year period where I'd get into anything that looked like it would be credible, something that would be sustainable. And of course, what would happen is I think most people are experience in the markets is you apply a strategy, it works, you make some money, and all of a sudden something changes and it's not making money anymore. You start to give back money, and then you're like, okay, this strategy is not working. So then you're off chasing the next new thing. And so I did that for 14 years. And that's probably typically most people's experiences are always looking for the next new thing, how to keep up with the market as it evolves and changes. And that's really the key, I think, component to what causes people to struggle and fail. Is that there's a constantly evolving market condition. It's never really the same. It's always evolving. We may have similar aspects to it, but the cycles when they repeat, they repeat in kind of different manner, different patterns, and it causes whatever strategy that was developed for a particular market condition, it starts to work inconsistently or not at all. And so understanding that there are variables in the market that cause the market to change, well, those are the things that kind of started to come into my I guess perspective. And after about 14 years, I had some events in my life that really were quite stressful, and they motivated me to kind of look outside of what I'd been doing for 14 years, and figured, how is it possible that over 14 years, spending over $300,000 on education and training alone, not including losses that I took along the way and the lessons those taught me, I couldn't maintain something that would be sustainable and consistent long term. And so one day I almost punched the computer monitor. I was so upset, and I went to the beach just to kind of listen to the waves and watch the ocean and just calm my mind and try to distract my mind from the rage I was feeling. And I noticed these surfers that were surfing, and it was the most interesting thing, because I remember very vividly that I started counting how many surfers there were, and that there was like 15 surfers, and they're all kind of trying to catch every wave that was out there in the ocean. There was two that were off to the side, and they weren't catching very many waves. And I thought, oh, they must be beginners learning how to surf. And then after about an hour or so, I realized, wait a second. Those two who barely took any waves, when they take the waves to surf, they'd have a really great ride, and they would have a good smooth interaction with the water. The other guys, the larger group, were just catching every wave they can. They would crash and burn. I thought, wait a second, those two are the professionals, not the amateurs. They had figured out some way to filter out the waves that weren't worth riding, and only took the waves that were actually not likely to cause them to have a bad ride. And I thought, wow, what a concept. What if I took that and applied that to the markets? What if I stopped looking for opportunities to make money in the market, and instead I started looking for opportunities that were not likely to lose money? And it changed everything. And that took me on my journey to discover and literally invent a whole new approach to the market I call market vulnerability analysis. I'm looking at what's vulnerable in the market. And so by doing that, some of the things that came into my perspective was the fact that there's actually 8 major forces of supply and demand that affect prices going up and down. But most people are trained to look at either fundamental analysis and or technical analysis. Well, those are just 2, but there's 6 other ones. And when you only look at 2 out of 8, it's easy to see why you'd be blindsided and surprised by things that seem to come at you nowhere, out of nowhere, right? And so that causes the inconsistency, causes a person to feel like, oh, I've got some good analysis. It looks like the market should go from here to here. And so you go in, and then the market, what does the market do? It comes in, triggers you in, runs against you, you stop out with a loss, and then the market runs after that and goes up without you. You're like, oh, it feels like somebody just targeted my stop. Well, the reason it feels so personal, the reason people have those experiences where they get whipsawed out of the market and the market goes where they think it's going to go, is because those are called prime pools of liquidity. Those are areas in which market makers, brokers, people with big funds that can go in and target unique areas, pockets where they can actually manipulate and cause the market to go one direction initially before the larger market takes over and that bigger wave carries the rest of the market in the other direction. So they get a better price average, knocking you out and then sending the market back to where it's supposed to go to begin with. So understanding what causes the market to move is very essential. So by doing that, you then eliminate those experiences where you get spiked out, whipsawed. You can actually see where they're going to be. You can take them into account, and then you're able to have a more consistent and steady experience, if that makes sense.
Yeah, sure. We'll discuss that in detail for sure. But I want to hear about what got you interested in trading. What got you started in the trading world exactly? Was it a connection you had or an experience? What got you into it?
So back then in 1996, it was just the big thing, the next new thing where people can make money working from home. They could trade off their laptop on the beach. That was very appealing to me back then. And I was, in my 20s. And so that was a very important goal for me, is to be able to have time freedom. For me, time freedom is the thing that I think drives me, and I think most people, to be able to come to the markets, make money efficiently. You don't have to worry about negotiating with anybody, working with anybody, depending on anybody. It's just you and your computer. And those are my motivations, was just my flexibility not to be stuck somewhere geographically. I understand you travel and you tend to go to different countries, and you're not limited and restricted. That's the whole benefit and the key to being able to work with the markets rather than working with geographically located businesses and working with people. So that was my draw.
Cool. And how was the learning curve? How did you learn your way through trading exactly?
So essentially, it was just buying into strategies and education and approaching the market the way I was taught. I'd make some money, and then something would start to change in the market, and it would start to become inconsistent, or I'd start to give back money. And by doing that, I started kind of going one strategy after the other over 14 years, where essentially I would go in, try to succeed with something, experience some success, and then all of a sudden I'd start to get let down. That strategy would stop working. And so I'd have to then go back to the drawing board and figure out, well, is there a version 2.0? Is there the next new thing? How do I keep up with the next change of the market's condition? And so I just kept jumping from one thing to the next until that burned me out. And then I kind of threw everything that I ever understood and knew about the market and just started from scratch and started to kind of break down, well, what's causing the market to move? What's causing it to change? And when I identified those aspects, then I engineered an analysis process to allow me to measure, well, number one, to identify, but number two, to measure and value the changes that were happening. And if you can measure the change, then you can actually be ahead of the market. So if you think about weather as a great example, weather, there's multiple factors that cause weather. So you can't just walk under a clear blue sky and have it start raining over your head. It takes clouds to roll in. And once they're over your head, it takes a certain environmental condition to allow those clouds to produce rain, because you can have a cloudy day without rain. So what we do is when we can measure those different pressures that cause it to rain, Well, here's the two factors that are important. You have to be able to identify those factors, number one. And number two, the fact that it takes time for them to build is what allows them to be forecastable. And so once we can forecast the oncoming weather, well, in the market, it's the same thing. When we can measure and value the oncoming poor market conditions, then we know that we're coming into a condition that's probably not going to favor our outcome. We know how to filter ourselves out and stay away from the market rather than going in at every opportunity we see. We now instead can filter, okay, there's 100 opportunities and maybe 60% of them will be winners, 40% of them will be losers. You don't know which one's which until you get into it and you either win or lose. Well, market vulnerability analysis allows you to actually filter upfront no less than 80 to 90% of the ones that are going to struggle and fail. So of the 40 that are going to lose, you'll be able to filter yourself out of them and avoid taking them to begin with. So you're trading less, right? Instead of taking all 100 opportunities that you see, you'll end up taking maybe the 60 that win and the 4 to 8 that are going to lose, and the rest you filter out. So you've taken a total of 64, 68 trades. Well, think about that. If you have a 60% winning strategy, right? So you have you're going to get a 60% win rate, but you've only taken, let's say, 64 out of those 100 opportunities. Well, 60 out of 64 trades is over 90%, right? Like 93%. You've got a winning strategy. You've got a strategy that's only 60% win rate, but yet you've turned it into a 90% experience simply because you were able to avoid upfront the poor conditions that weren't favorable for you. And that's what market vulnerability analysis does for you, if that makes sense.
Yeah, and that's really important because a lot of people find these like these setups online that they want to trade, and they hear this in books and stuff, but their setup they trade it all the time the same.
That's
And
correct.
like you mentioned, you got to be able to find out when it works, when it doesn't work. So how do you tell people to do that? How what do they have to look at to be able to see when a setup is like to work versus not like to work at all?
So what I did was I had to develop a way to calculate all of the 8 major factors in an efficient, quick way, rather than me having to essentially keep going back and looking at the paperwork, looking at different monitors. It was just a lot of work initially. So it was very cumbersome and very overwhelming. So I started to figure out how I can combine each of those factors into a visual indication. I combine them into one indicator that looks like an oscillator, but doesn't work that way. And that kind of gives me the aggregate total of the impact that each of those factors are likely to have on price. So it acts like a fuel gauge. So it's a very simple visual. Like if you sat in your car and wanted to know, you want to take a drive 250 miles long. If you sat in your car and you looked at your fuel gauge and your fuel gauge says, well, there's only a quarter tank of gas in your car, you know immediately just by looking at that. You don't have to go look at under the hood, look at the engine, you don't have to break anything down. You just look at that visual indication of a quarter tank of gas, and you know that's not going to take you 250 miles down the road. You have to stop and refuel. So that guides your actions. So I've developed that indication to give me a visual cue of how much fuel can power the market up or down for each particular, for any symbol, for any time frame, any market condition. And then I developed a process to analyze and be able to use those inputs to be able to forecast at least with an 80% or better accuracy of what I can expect the market to do. And that's what creates the consistency and the steady approach. Does that make sense? Does that answer your question?
Yeah. Are you able to mention some of these factors people should look at more? You mentioned these 8 factors. Are you able to give a bit of detail about what those are?
Sure. So let's go through each one. So there's obviously fundamental analysis. There's technical analysis and all of its subsets like GAN, Fibonacci, and all, and in all the different major components that people will use in technical analysis. Some of them are, MACD and other things, right? There's momentum indicators, there's relative strength. All these things will be actually utilized in technical analysis. So there's the major category and there's the subset that goes into it that we want to calculate. So those are two. You've got imbalances in supply and demand that we measure. Market sentiment is taken into account. Volatility is taken into account, and all this different phase shifts and whatnot. Then you have liquidity pools, and that includes volume, trade flow, order flow. And then you have something else we call the prime liquidity pools, which is what I told you about earlier, that's a major component. And actually, what's interesting is um, with the prime liquidity pools, those are areas that we have to take into account because there are pockets in which where people say, well, the market's rigged, it's manipulated. Yes, absolutely it is. But it can't be manipulated beyond what the whole market is able to withstand. So if you think about a pool of water, if you throw a brick in the pool of water, it'll create a splash, but you can't displace the whole pool out suddenly, right? It has a limited impact. So we're able to identify those as well. And then lastly, geopolitical impacts. That includes central bank, macroeconomic impacts. Those are the 8 major forces of supply and demand. And if you don't take those into account and know how they're going to impact price, you're going to be blindsided by one of those things or multiple forces that if you're just kind of looking at an opportunity, you won't know why it worked against you, right? Until it's too late. So by looking at those major factors, and by the way, I simplify all of that. They are all calculated into that one simple little indicator that shows an aggregate of what it actually is going to do for price when you combine those 8 factors, if that makes sense.
How do you quantify the geopolitical forces? How are you able to define that and know that's going to affect some trades or not?
So that's one of my proprietary methods is I have been able to identify based on some news sources. Now you have the ability, a lot of people have news sources that give them kind of indications of what news will do to price, right? You've got algorithms for that. So we take advantage of that data and understanding that what news is available, how that's likely to impact price, and we take that into account as well. So that's part of the calculations that gets figured out. But again, it's something that actually is already done behind the scenes for you, and it just shows up as this nice, simple, almost like a fuel gauge. It's an indicator at the bottom of the screen below your price that helps you understand, okay, there's enough fuel here to power price up, or there's not enough fuel here to power price further up. It helps you understand what you can expect with a at least an 80% or better accuracy.
How would that work out if you are, let's say, a day trader compared to a higher time frame trader? Because of course the forces will be different. The things that affect the market on a longer time frame level might not affect the same thing on a lower time frame.
Correct.
How would you deal with that? How would you be able to adjust with that?
So that's an excellent question. So think of like when we look at weather, you know how you have the what they call Doppler radar, and then they have the satellite images, and you could see, you can either look at a local region and kind of get the forecast for the next 4 to 8 hours there, or you could see a much bigger view, like multiple states, just multiple regions, and see how the weather patterns are building and shifting. And so like when they are forecasting a hurricane, they have to look further out than just the local region to see that, hey, in the next 48 hours, a hurricane is going to be coming on shore. So with market vulnerability analysis, it's able to actually zoom out or zoom in based on the time that you're interested in, whether you're a day trader, whether you're a swing trader, position trader, whether you're a longer term investor, as an example. So right now for long-term investors, the market vulnerability analysis will tell you this now is no longer a time where it's conducive to be holding a position longer term. This is a time in which market vulnerability analysis says it's speculative and more of a gamble to hold on to things long term. You have to look at the market on a day-to-day basis at minimum, because we've just entered into an environment that is conducive for a strong correction or crash. And that leads me to another point, actually. So think about it this way. Just like we can't go, like I said earlier, you can't go outside under a clear blue sky and have it start raining, right? Okay. The market can't crash and it can't correct in a significant way without an environment that's built up and ready to make that kind of a move available, right, or allowable. And then all it takes is something to trigger that move, then it happens. As an example, if any of your audience are familiar with a company called Chipotle Mexican Grill, they're in the United States here. They were a high flyer. Their stock was up and went up to like 700 and something. And they had all of a sudden they had an E. coli breakout, and people were getting sick and some people died from their food. Well, when that happened, that's something obviously nobody can forecast. That caused that stock to crash significantly. Now, most people say, well, you have no control over that. Market vulnerability analysis actually would have an opinion on that. You would have seen that several weeks before the crash occurred, the actual environment surrounding Chipotle stock was actually conducive for a significant correction. It was no longer supporting a continuation of those prices, especially if it was going to try to continue higher. There wasn't anything supporting where the price level was at, and it just took a trigger. That was the trigger. And so then it crashed. So in other words, you could have known ahead of time to take defensive action using market vulnerability analysis. If someone has a position in Chipotle Mexican grill, they would have been able to actually forecast, hey, this thing is actually not supporting its weight here where the price is at. We're likely to see a correction or a crash. They'd be able to defend themselves against that and not be surprised, despite not being able to tell that there's an E. coli breakout that's going to happen. It doesn't matter. It's the environmental factors that we look at to help us know whether a market is able to sustain its price level, go higher, or ready to pull back. Does that make sense?
Yeah, it totally makes sense. Is we're looking at the market the same for every kind of market, like for example, currencies, stocks, cryptos, or is it different? I'm guessing it's similar, but maybe some technicalities will change a little bit.
Yeah, and actually it's actually exactly the same because all of those forces are applicable to currencies, to crypto, to futures, commodities, stocks. When someone trades options, they have to accurately analyze the underlying asset, what it's going to do in order to have a successful options position. So it doesn't matter what you're trading. The analysis is agnostic. It works equally the same, regardless of the market, asset class, condition, direction. And that's really important because we've been in a long bull run. So a lot of people have made a lot of money, but we don't want to be we don't want to have a false sense of confidence either, right? All boats rise with the tide. The tide's been rising. So, it's not hard to make money when the market's going up. But what happens when the market shifts and goes down or turns into a bear market for whatever reason? You have to be able to navigate that and know how to make money the same way, equally as well when the market shifts, or if it's just going chopping sideways. You have to have some control. And that's what this allows you to do. It gives you confidence through the control provided by the consistency that the analysis provides.
So that was my last question. So, what are your thoughts on the market these days? A lot of people have been talking about the crash of the stock market for a long time. They've been talking about the Bitcoin bubble and things. What do you see happening? And do you think we're there or not there yet?
So that's a great question. So I've been, when I do my forecasts, I do a lot of forecasts. Most of my forecasts, I do them live, usually in front of an audience, in front of others, because you can't fake that. Just people to verify that. And so one of the things that I'm telling people now, obviously people that are in our circle, of course, our clients, we have just entered into a market that is now ready for a significant correction or crash. And it's going to be one of those things where you have to analyze on a day-by-day basis when the environment starts to shift and begin to work on moving even lower. Where we are now is a place where people should be paying attention day by day. I wouldn't go a few days without looking at the market. I'd be looking at the market at least once a day in the morning, preferably in the morning and at night, so that you have a sense for, you want to keep your finger on the pulse because we're in a sensitive time. One of the unique advantages we have with market vulnerability analysis is the real-time data and the ability to tell you kind of what you can expect and anticipate before it occurs. So, but in order to get the accuracy, you have to be more willing to be on top of it and not walk away and sit and be lazy about it, right? So right now, we are in that environment where we need to be looking at it on a daily basis. Just a few weeks ago, you could take, you only have to look at it once every few days, once a week, you'd be okay. Now we're in an environment where you should be looking every day because it's sensitive. We have room to either kind of recover from the pullback we've just seen currently in the market, but that has to be confirmed through the analysis of the other factors that helps us to see, yes, is there follow through? Is there participants? Are the rest of the forces coming in and lining up and building to fuel the market higher? Or is it unsustainable, and are we looking for another pushback down? And so that's going to take a day by day analysis to see where the environmental balances are going to lean this way or that way. So I would be very vigilant right now. This is not the time to hold on to something and hope that it'll be okay over the next few weeks or few months. We need to be more vigilant to at least protect ourselves against the downside.
I'm guessing that your analysis helps people get into trades, like we discussed that before, but also get out of trades that they're in right now. Maybe some people have been investing for a long time in the bull market. So how much tolerance do you have for market coming down and trying kind of going against your trade? Do you get out right away when you have the first sign of it, or do you leave it some room for maybe recovering, going back on track after?
Yeah, you do. There's a couple of things that are entailed with that. We do have a tolerance for a market that pulls back, but one of the ways that we mitigate risk is the way we position size. So because of the level of control that we have over the accuracy and the consistency, we can actually position size so no position can really ever needs to take on more than 2% risk. You can take less risk, but never more than 2% in a position. So we never hold on to large drawdowns. Those are non-existent. We don't take big risks. But by being able to compound, these smaller positions that don't take a lot of risk, you're able to actually accelerate and compound your earning potential. So you can have market-beating performance without taking big risks, without holding on to large drawdowns, and really, essentially, probably the biggest factor is you don't have to be aggressive in order to beat the market. You can actually let the market come to you, and because of your ability to filter. So what we do is we allow the market, we set a position, we allow the market to do what it needs to do, and we are able to monitor whether the conditions are favorable to continue forward, or they're no longer favorable and the odds are beginning to stack against your position. Therefore, you're predicting failure. You're able to actually exit out of position before it turns into a problem, or you can let it just stop you out and you'll have a full 2% stop. So we do have a tolerance, but the magic is in position sizing correctly so that you're not holding on to large drawdowns.
So where can people find you? They'll connect with you or reach out after this interview.
Absolutely. People can find out more information about market vulnerability analysis at raiseyourfinancialiq.com. It's just the letter I, letter Q, raiseyourfinancialiq.com. There'll be a case study there, and there'll be some education from understand all the different forces, how we use them. There'll be some examples of what occurs, what people experience when they use those factors and apply the methodology diligently. And then there'll be an opportunity for people to engage with me there if they'd like to connect with me and have an evaluation to go over their situation and see if this is an appropriate fit for them. They'll be able to do that at the end of that process.
And you do have a YouTube channel as well, right?
We don't currently have a YouTube channel, no. But I've not been as good about the social media aspect as I probably should be. Been a little bit lazy about that. But right now, for the time being, the raiseyourfinancialiq.com is kind of the website for getting information and seeing example videos there.
Okay, perfect. So make sure to put all the links in the show notes anyway of the podcast and on YouTube as well. People can just search in the description. That's all going to be there for sure. And thank you, Roger, for this interview. One question I ask my guests at the end is, what is one piece of advice that you want to give people that would really make a big difference in their trading? So if you give people one piece of advice, what would that be?
Yeah, the biggest one is stop looking for opportunities to make money. That is the reason why you're struggling with inconsistency. When you look for opportunities to make money, you create a tunnel vision. You have this target you just want to hit, and you don't realize all the risks that are going to be there. They're going to affect that opportunity. So instead, start to look at opportunities that are not likely to lose money, and that'll change your whole approach and your perspective on the market. And so as you're doing your analysis, you'll start to be more open to seeing what can go wrong with this versus how can I make money with this. And that will have a dramatic impact. That was what changed everything for me, and that allowed me to develop and invent market vulnerability analysis. So it does change everything for you.
Very nice, very nice. Thank you, Roger. I appreciate the time. I appreciate the advice you gave to the listeners, and I'll catch you guys pretty soon.